Thanks, Raleigh. Thanks so much for having me. It's great to be back here at TradingPub. As Raleigh said, we're going to be going through swing trading strategies today, and I'm going to be showing some ways that you can take your own swing trading strategies and improve them using some quantified historical edges, and I'll use some example swing trading strategies as well. I need to slow down that talk, I guess. Just so everyone knows, you will be able to get a copy of the slides at the following link, InvestiQuant.com/TradingPub. So at the end of the presentation, if you want to go there, you can get them and download them. And I'll show you that link again later on in case you missed it. Before I get into it, I've got to give everyone time to read the disclaimer. A lot of the information I'm going to share in the presentation is based on hypothetical back-tested data. And for my own trading and education, I have found backtesting and historical data to be of great value. But history doesn't always repeat itself exactly the same way. So just because something worked in the past doesn't mean it's necessarily going to work that way in the future. That said, let me tell you a little bit about myself and about InvestiQuant. I had a site called Overnight Edges that I started in 2012, which last year merged with a site called Master the Gap that was run by Scott Andrews. Master the Gap was primarily a day trading site or intraday type trading, and Overnight Edges looks to take advantage of overnight trading. Additionally, I've been a swing trader for many years, and I've written and published a lot with regards to swing trading. I have a swing trading site as well, and we've now incorporated swing trading into InvestiQuant, and that's what we're going to be talking about today. Now, InvestiQuant, the way the union came about is we actually had some members come to us separately, and they said, hey, you guys have real good stuff. You should get together and do something combined. And they knew we were friendly because we presented at times together and so forth. And Scott and I talked over the years. And it took us a few years to figure it all out, but we ended up actually raising money from clients of Master the Gap and of Overnight Edges who really wanted to see us get together and expand what was offered there. And so we took some seed capital, and InvestiQuant was born. And we're real excited about the new site, and our swing trading service has been live since September. And I'll explain a lot more about that to you as well. I've been trading since 2001 on a full-time basis. Scott has been doing it for about 10 years, so between the two of us, about 25 years of full-time trading and research. And one of our board members at InvestiQuant actually is the head of Quantitative, Duke University Center for Quantitative Modeling, and they've done a lot of heavy-duty quant work for us on evaluating many of the systems we have. So that's been real helpful for us as well, and creates some real interesting information. Anyway, moving on. Today I'm going to talk about what I mean by quantified historical edges. We'll get into that a little bit. It's not just looking for a pattern and buying or selling stock based on what a chart is telling you, but it's actually understanding percentages and profitability over time associated with that pattern. I'm going to talk about two simple swing trading strategies. And I will share those strategies with you, and on their own, they're pretty good strategies, actually. But I'm also going to show you how to improve those strategies. So we'll look at the strategies, I'll show you results on them, and then I'll show you how you can improve them using some quantified data that we have available at InvestiQuant. Let's talk about quantitative trading a little bit. Investopedia defines it as trading strategies based on quantitative analysis, which rely on mathematical computations and number crunching to identify trading opportunities, which seems like a mouthful to me. Basically, it is looking at how the market has performed under similar market conditions in the past. And there's many different definitions of similar. And so we'll get into a few of the definitions of similar today. But that could be similar price action. It could be similar breadth action. If you look at breadth, it could be similar seasonality, right? Whether you're looking at time of the year, time of the month, or certain holidays. Thanksgiving's coming up soon, and there tends to be seasonal tendencies around Thanksgiving for certain markets. So looking at how the market's done historically based on a similar setup. And it can be used either independently, so you could actually take trades off of historical edges that you find, or you can combine them with other methods to improve your own trading. So if you have certain techniques that you use, and we're going to use some examples, you can improve those results by considering what history has done as well. I'm sorry. Backwards, not forwards there. It is important to know that while a lot of the stuff I'm going to be sharing today is pretty simple, to identify a true historically based, quantifiable edge, you do need to do some comprehensive analysis. There is a tendency for people that when they begin doing quantitative analysis to mine data extensively, and that's not really what you want to do. You want to make sure that you got a decent sample size, and that there is some reason that the results might be coming out the way they are. I'm going to talk a little bit about ensemble forecasting as well. This is a quote from Mike Gilliland of SAS, who's wrote it in Lessons from Forecasting the Stock Market. It says, there's a well-recognized phenomenon that combining forecasts derived from different methods using different sources of information can improve forecast accuracy. This approach is sometimes called ensemble forecasting. And that's effectively what we do with our strategies at InvestiQuant. The idea is, and it's not limited to the stock market, it's actually something that they use National Weather Center. They'll look at different models, and what they find is that the average of their models generally produces a better forecast than any singular model does over time. And that's true as well for stock market forecasting. So if we can design a model based on price action, we could design a model based on seasonality, and on their own they might be terrific models. But if we combine them, or if we average the results out, or the predictions out, then we can often have a much better model than either one could be on their own. So if you have multiple edges all pointing in the same direction, you're normally much better off than if you have one thing that is suggesting an edge and one thing that is suggesting that there is no edge, or perhaps an edge in the opposite direction. So I'm going to go into 3 different concepts that we used in building our swing trading strategies. And these are acceleration, momentum, seasonality. So we have historical guides at InvestiQuant, and they are based on these 3 concepts. And all 3 of these have given a solid edge over time. When I talk about acceleration, I'm talking about how fast is the market moving and from where is it moving. So in the example shown here, this is just a simple chart. You can see that we've got an accelerated move happening to the downside, and it's coming out of a consolidation area, and it's now at new lows. In the past, I've shown examples of, you get a strong move, maybe a one-day move or a two-day move. Is that move coming off of a high? Is it coming from a very low area, like a 50-day low or a 50-day high? Or is it coming somewhere in between? Is it near the 50-day moving average? And so a strong move from these different areas can mean different things. Our acceleration models look at how fast the market is moving, where it's moving from. Okay? Momentum is another concept, and that looks at how persistent the move's been over the last number of days and weeks. How strong is the movement? Where is it trading in relation to the long-term trend as well? So what we see here is a nice persistent move higher, and that would give us a different market environment than if you had a persistent move lower, or if you had a choppy move higher or lower, or a sideways move. So we're looking for how persistent has a move been and what direction is it going in, and where is it in relation to an even longer term trend. Seasonality is the third concept that we take advantage of, and seasonality I found to be greatly useful. And we're looking at long and short-term seasonal forces that might be in play, and we want to see how has the market performed during similar periods in the past. So seasonality could be something as simple as performance around a holiday like Thanksgiving. It could be something like how the market has performed different times of the month. First trading day of the month is often a strong day. You get institutional flows coming in from 401ks being funded. And I'm going to go through a seasonality example in a little while. Also, certain times of the year the market tends to do better than others. And there are also long-term seasonal cycles that some people take into account, and that we take into account in some of our models as well. I'm having trouble seeing the chat a little bit, just so people know. So feel free to put your questions in. If I don't answer them right away, I will try and get back to them. I'll make sure to get all of them at the end, though, if there's things I miss along the way. All right, so each of these concepts, acceleration, momentum, and seasonality, can be used on their own to create edges. But like I've been saying, if we use an ensemble, what if we combine them? And that's really what we're trying to do, and that's how we've been able to build some real strong edges. And what we look to do at IQ is we'll show the historical odds of a certain symbol or market closing up or down over the next 3 days is where we're looking to project out. So for our swing systems, there's actually used 3 different methodologies. So there's 9 total systems. And those methodologies are acceleration, momentum, seasonality. And each of them is broken down into 3 different time frames. So we have a 1-day acceleration system, a 3-day acceleration system, and a 5-day acceleration system. And those 3 systems are similar in concept, but different in how far they look out and how far they look back and exactly what parameters they're using. Seasonality, same thing. It's related to seasonality, but one of our systems looks at just seasonality for tomorrow. The other one will look out over the next week. All right? And we look for similar market conditions over the prior 10 years. So we run a rolling 10 years forward. We're looking for how has the market performed during the last 10 years when acceleration has been in this type of state, when momentum has been in this type of state. We validated the data going all the way back to 1971 was our earliest tests. And we've looked at it across many symbols and many markets. And basically what we're trying to do is identify times when there's been a clear short-term directional bias that has existed based on any of these things. And what we found is that when a number of these things line up, then you've got a real solid edge. So I want to go through and show you on our website what the information looks like, simply because I'm going to be showing you some trading techniques that are separate from our guides, and then I'm going to mix our guides in there. So this is a screenshot from InvestiQuant, and this looks at the XLP, which is a consumer staples select sector spider ETF. And what you see is there's a couple of stats here. One is the win rate we want to show here. So this shows that on an average of 3 days later, XLP would have been higher about 62.5% of the time based on the average of our acceleration, momentum, and seasonality systems. And the average profit factor of those three systems, profit factor is just a profit metric used primarily by system traders, and what it looks at is the gross gains divided by the gross losses over time. So it's generally used to compare systems to each other. So if one system, if for instance, a futures trader is comparing two systems and they both made $10,000 over the same period of time, he might use profit factor to compare them. If one system made $20,000 in gross gains and had $10,000 in gross losses to get to that $10,000 gain, that would generally be looked at as more favorable than a system that had $100,000 in gains and $90,000 in losses to earn that same $10,000. Right? A lot more work, a lot more risk generally when you've got gains and losses that are of that ratio. So it's just a ratio, but it's a helpful one when considering risk. So we want to know the percent chance that you're moving high, that the market will move higher, and then a risk metric that we use called profit factor. Anything above 1 means it's been profitable. Anything below 1 would mean it's been unprofitable. Okay. We show green and red buttons here, showing you, all right, this is how whether if they're all green, that means acceleration, momentum, and seasonality are all showing positive profit factors. If they're red, that means they're all negative. There's also different shades. There's yellow if it's neutral, and orange as well. Anyway, those are the metrics we're going to use, and I'm going to factor in when we move on here. Just check and make sure there's no questions on that. Don't see any. Okay. Hopefully you're all with me. So how can we use this information to improve a swing trading strategy? Let me show you a very simple but really quite effective swing trading strategy that I call my 5-day low, 5-day high strategy. All right, and this is all the 5-day low, 5-day high strategy does. It looks at closing prices. So if you trade candles, you might have a green candle here where you got the open, high, low, close. Or if it's a doji, you got the open, high, low, close. Or if it's a down candle, doesn't matter. We're just looking at the closing price. Okay, so the entry rule for the 5 low, 5 high strategy is to simply buy the day after market closes at a 5-day low. So you're looking for a 5-day low to appear. We're going to buy the next day using a limit price of today's close. So if you're looking to, if today we close at a 5-day low, we're going to buy tomorrow morning using a limit of today's close. So if there's an unfilled gap up, you won't get filled. But if there's a gap down, you'll get a better price than today's close. And if there's a gap up and then it pulls back a little, you'll get a better fill than having to pay for the gap up. We're going to hold on to that trade until the market closes at a 5-day high and then exit there on the close. So let's just look at a simple example here. The bar marked 5 here. can't remember what month this is. It's blocked out at the bottom. But anyway, you got a 5-day down move here, or a down move to a 5-day low. You would look to buy at the prior day's close here, and what happened this day is it gapped up, it came back, it filled the gap, and then it moved nicely higher. Right? And we're going to look to hold on to that till it closes at a 5-day high, which was actually done just 2 days ago. Okay, so that is an example of a simple swing trade that would be, this line should be there. That's where the buy happens. It'll be executed over a course of 2 days. Right? And then you wait for it to set up again. Days, probably have one there. Get entry here. And here would be your 5-day close. So that would have been the next one. So hopefully you'll understand the rules. They're about as simple as you get. And this is how it would have performed just using that very simple strategy going back from 2007 until the end of August of this year. Right? Over time, there would have been 144 trades. Nearly 71% of them would have been profitable. And we would have seen a profit factor of 1.47. This is looking at entering using $100,000 per trade. So with the average trade net profit of $354, that means that the average profit would have been 0.35% on these trades. And you would have been in the market a grand total of 851 days. Here's a chart of how that strategy would have looked over time. So it went through some moderately rough drawdowns a few times. But generally, it's been pretty good, and it's worked its way higher over the last 8 years or so. And even going back further, it would still look good. The reason I went back to 2007 in this example is that our historical archives, our complete historical archives for SPY for our for the IQ data is available back at the beginning of 2007. So I wanted to run a comparable period. So what if we combine this 5-day high-low or low-high timing strategy with the IQ swing edges data? On its own, it's pretty good. Let's see if we can improve it. And what we're doing here, you remember I showed you where we have the metrics for win rate and profit factor. Well, I just took the same strategy and I said, all right, let's say it closed at a 5-day low and we have a win rate of at least 55% and a profit factor of at least 1.3 for SPY. The 55% and the 1.3 are metrics that I generally use for my own trading, so that's why I picked those there. They tend to be pretty good, even on their own, of suggesting an upside edge. Some people prefer them to be higher, more consistent. Some people will say, all right, anything over 50 and 1 or 1.1 is fine with them. So it really is kind of dependent upon how strict you want to make your entry criteria. But I chose 55 and 1.3 there because that's a general number that I often use. So then we're going to buy the next day at today's limit price, just like before, and we're going to sell at the 5-day high, or we will sell when the IQ swing edges data no longer meets the 55 and 1.3 criteria. So doing that, we were able to move our profits up to 57,000. We were in the market 449 days instead of, I think it was 851. Percent profitable, the percentage of trades did not go up, but the profit factor did quite a bit. So if we look at a profit curve, we can see it's actually been much steadier, and we've had higher gains over time. There's really only this is the only tough dip right there, and that got corrected pretty quickly. So look at a comparison with and without swing edges. You would have had 119 trades instead of 144 trades if you incorporated swing edges data. You would have been in the market about half the time. Net profits would have gone up by 13%, even only being in half the amount of time. Your average loss is lower. The max drawdown is substantially lower. Buying every 5-day low isn't necessarily the greatest of strategies, although it's not the worst either. And your average trade actually moves up as well. So you have fewer trades, fewer days exposed to the market, more total profits, and smaller losses. That seems like a nice way to improve on a simple strategy. Right? That's kind of the idea of what you would want to do. Let me teach you another swing trading strategy. And this one's just a simple seasonal swing trading strategy. Years ago, I used to write for trading markets. So everyone is familiar with trading markets. Larry Connors runs that, and he did for years. And so the first time I saw this type of information was published by Larry, where he talked about how different times of the month the market tended to be stronger and weaker. And so I was thinking about that recently, and I went and I created a little strategy that looks to buy near the end of the month and then sell at the beginning of the new month. And the reason that there's several reasons that this may work well. Most common theory is that there tends to be a lot of inflows into the stock market near the end of the month or on the first of the following month, and that large portfolio managers know that these flows are coming from 401k funds, and so they need to put their capital or the anticipated capital at work over that time, and that tends to push the market higher. So the rules for this simple seasonal strategy are: today is the first trading day after the 24th of the month. So if we're August here, today would be Monday would have been the 24th. Today is the first trading day after that. We're going to buy SPY, the S&P 500 ETF, tomorrow at the open. Right? And we're going to hold it until the first trading day of the next month. We're going to sell on the close of that day. Sounds easy enough. So here is the results of doing this. And again, I went 2007 to present here, and this is actually, this is until present day. Through November 1st, 2015, if you're listening to the recording. There would have been 106 trades during that time period. Nearly 60% of them would have been profitable. The average trade would have made about 0.25% for a net profit of $25,000. And if you want to see a profit curve, I produced one here. So a bit choppy, but pretty nice upslope over time. Headed in the right direction. Lower left to upper right. That's what you generally want to look for, right? Now I also ran this back a lot further, just so people could see that this wasn't just a recent phenomenon. Sorry, thought I had that slide in here. I had a longer term slide with it in there as well. But I went back to 1995, and you can see that the curve went higher and higher and higher over time. So this wasn't just the best period being the most recent period. Actually, this is one of the tougher periods of time. It has been a valid strategy for a long period. So let's then take this strategy, and like we did with the other one, what if we combine it with IQ's swing edges? So Today is, again, the first day after the 24th of the month. And I also said, but it's not the last trading day of the month. And the reason I said that is because we are requiring swing edges readings are showing a win rate of at least 50% and an average profit factor of at least 1.1. So I lowered the numbers here quite a bit so I would get a good number of trades. I didn't want to make it too narrow. And since there is a requirement here, I didn't want to have it be the last day of the month and then we buy the first day of the next month and at the open and sell the close. We're looking for a swing trade. We're not looking for a day trade. That would be a day trade, right? You buy the open, sell the close. So this means we're holding for at least a day and a half, 2 days. So now we're buying the open, selling the close, first trade into the next month, or on the open the morning after the win rate and profit factor are no longer met. So we could get out before the first day of the next month if the published odds weaken. In this case, profit factor goes up. We're not in the trades quite as long. And the number of trades does go down just slightly. So normally we've had, you could have 2 trades during a period, right? You get in and out a couple times, or there could be months where there's no trades. But overall, the number of trades has been about the same. Here's the profit curve there. See, it's moved nicely higher. It's back up right near new highs now. And if we can run a comparison, what you see is that without swing edges, there hasn't been much difference in the number of trades, but the number of days invested has been reduced. Now, this would be reduced more if I was more strict with the criteria, if I did the 55 and 1.3, for instance. But I was pretty loose with the criteria, so we only reduced the number of trading days by 21%. But even just reducing it that much, we saw profits increase nearly 50%. The average trade was up over 50%, and the max intraday drawdown, which is, for many people, the most important, was reduced by over 50%. So we had a bit less exposure, but much less drawdown and substantially better profits simply by taking history into account with this seasonal system. Let me show you another way to use the data. A lot of people will use it as a standalone strategy as well, and you can certainly do that. And then you can also mix it with technical analysis. And I'm going to show a couple examples. I'll show an example there as well. This is a chart of SPY from January 2007 to September 2015. Again, I'm going back to that 2007 because that's as long as we have lead archive. We go back 10 years from 2007, so back to 1997 is as far back as we were able to build our acceleration model that does use some intraday data. Complete intraday data going back that far. Momentum and momentum and seasonality we were able to build back much further. Like I said, 1971 we went back for on SPY. That didn't start till 1993, but on the S&P 500 index itself. So anyway, from 2007 to 2015, the market saw a 44% rise. There was 3,160 market days, and there was a max drawdown in here of 52%. If you instead decided, all right, I'm just going to trade when the odds appear to be in my favor, based on the average of the IQ guides, you could have used, it's about as strict as I get in most of the research I publish, 57% win rate and a 1.4 profit factor. So only go long when the readings are showing at least an average of 57% win rate and a 1.4 profit factor You would enter tomorrow using a limit price equal to today's close. And we do that because the guides aren't available until after the market closes. And you'd sell in the morning after they no longer meet the criteria. So you're just looking at the numbers and trading the numbers, not worrying about what a chart says, which makes it an easy buy-sell decision. As you can see, the curve would have been a lot nicer. The drawdown goes from 50% to only 7%. You're in the market with that about a sixth of the time, or a seventh of the time, somewhere between there. And instead of 40%, 44% growth, it would have doubled that. So twice the growth, a sixth of the market days, much less drawdown, simply by paying attention to historical numbers. But a lot of people won't want to base their decisions just on historical numbers because they already have techniques that they use, and you probably have things that you use that you have confidence in. And some people are technical traders. So, we have a guy in our office, Matt, who is a strong technical trader. And this is a trade that he found just this week. And this is looking at BBH. And BBH, as you can see, had this level that it was reaching a few days ago, where we had pulled back to, and this level had been important a number of times in the past. So here we see two pullbacks to this level around 120, 121, where both of these pullbacks ended. The market was able to rise off of them, creating a support level. That support level was subsequently broken on the third try, and then it became a resistance level when it tried to get above it. Again, on the third try, that was broken, and now it was coming back down to test that level again, and Matt's theory was that it might work as a support level. So rather than just buying, he went ahead and checked the BBH guide for this particular day, which I think was November 13th. November 13th, long entry said 60.5 chance of a close higher over the next few days, and a profit factor of 2.38, both very strong numbers based on our guides. And so he went and took that trade, and as you can see, the setup with the IQ led to a 5% gain over the next 3 days. So it's a nice confirmation of signals that you might already have. Personally, I also go the opposite way with it, where I will look at we have a tool that will allow you to look through our data to find the strongest edges based on the numbers, and then I'll flip through those securities and look at their charts to see if that works. Actually, let me show you that. I have a couple minutes here. So this is the current guide for XLU, and if I go to our swing list here, this shows all of the stocks in our database, and right now we've got, I think we're tracking 5 or 6 futures, mostly the index futures and oil, the other one. And then we've got about 50 ETFs, and then every stock that has at least 10 years of data that is a member of either the S&P 100 or the NASDAQ 100 shown. So what I like to do generally is you can sort this either by symbol if you're looking for a particular one, or name, go by win rate to find the ones with highest win rates. I like to look at profit factor. That's my favorite, so I'll go in here and sort by profit factor. We could also filter these things out if you want to look at a smaller list. But I'll go and find some here, and then I might look at the details on it and see what acceleration, momentum, and seasonality are saying separately. You can even break this out and show the number of instances for each system and how strong a win rate and profit factor they're showing. And then I'll go in and I'll look at the chart. So I'll check out the chart of SPAC. This will create a little hit list for me. I'll look at the charts, and then we can see if those work out well. Okay. So in summary, showed a few different systems here. The 5-day low-high system, which you can take and use on your own or incorporate it with other data you have. The seasonal swing strategy, which can be used as a strategy on its own or, again, incorporated with other data, including IQ data. But they're both pretty nice little timing techniques. And then we have one of the things that I think we showed was that ensembles, meaning groups of strategies, such as the IQ groups of strategies, have done a lot better than just looking at a singular strategy. So if you combine multiple strategies, that tends to be more predictive and you can get better results over time. And IQ swing edges can be used on their own. You can use them to complement other swing strategies, or you can use them to complement techniques like technical analysis. For people that want to download the slides, get more info on IQ or anything related to that, feel free to go to investquant.com/tradingpub and just sign up there with an email, and you will see, you'll be able to download these slides directly. Make this a little bit bigger. Oh yes, so we have a $100 off coupon there as well. So Neer was asking about max drawdown. Was that on the, I think I got to that. Was that on the 5-day high-low system, or or the seasonal system? Sorry, I missed the question when it came through. And again, happy to answer any other questions you guys might have right now. Made sure to leave a few minutes here at the end. I apologize if there's a bunch of noise in the background right now. There is a leaf blower near my office window. The leaf blower only comes around when I'm in presentations, by the way. All right, well, thank you, everyone, for attending. I'll stick around another minute or so to see if any questions come in. But thank you again for TradingPub for having me. I always enjoy getting together with TradingPub, and I'm honored to come and speak here. Graphs of the 5-day systems again. Sure. So this is the 5-day high, 5-day low stats, and this was the results assuming it's the profit curve, and you can download this yourself. Profit curve assuming you took every one of those trades, and then the profit curve changed to this one if you further filtered it. All right, so it became a bit straighter. You still have this dip here, which maybe equivalent to this one. Probably missed out on a winner or two and had a couple losers in a row is what happened when you filtered them out. Overall, a lot steadier upslope.